5 bearish candlestick formations. I want you to envision yourself looking at the charts. You're starting to watch the market trend down. The market's making lower lows and lower highs. And so as the market makes lower lows and lower highs, it waves. And so every time it starts to wave and pull back up, we're going to be looking for a bearish candlestick formation after the retracement of a nice down move. And so with that bearish candlestick formation, that will be a signal that the market is getting ready to now make a new lower low and a lower high. And so let's start off with the bearish shooting star. Now the bearish shooting star is the exact opposite of a bullish shooting star. It's just that instead of the market going bullish, this is going to go bearish. You have a full-bodied bullish candle followed by a indecision decision candle. This is somewhat of a hanging man or a dragonfly doji, if you will. This, once again, is a U-turn. It's communicated to the trader. The markets may have been rallying and now is getting ready to U-turn and make a lower low and start to break out toward the south. When you see this candlestick formation, how do you trade it? In the exact opposite way that you would a bullish candle. You would enter the market at the opening of the next candle, place a protective stop loss above the high with an anticipation of the market continuing to fall. This is what it looks like actually in the actual market. Now here you are sitting in front of your computer. You're watching these candlesticks form. You could be watching a 5-minute chart, 10-minute chart, 20-minute chart. You could be watching a half-hour chart, hourly chart. But all of a sudden you see the market is waving down and now has retraced back up. And after the retracement of this down move, all of a sudden you see a bearish shooting star. Now this bearish shooting star is literally communicating to the trader, we're about to incur a U-turn. This is what it looks like. It's those two candles together. And so how would you trade it? You would enter the market here, placing a protective stop above there, and this becomes all your profit. This is what happens. See, we'd be anticipating the market to be coming down because trading is all about buying low and selling high, and shorting the market is just doing the opposite. You enter the market selling first and buying second, but you need to buy low and sell high in order to make a profit. Here we have what's called the bearish evening star. Now remember we had the bullish morning star. This is a bearish evening star. This is once again, a U-turn that is communicated to the trader. What you have is you have that bullish candlestick formation followed by indecision, followed by decision, complete U-turn. It's telling the trader market's getting ready to blow south. And how do you trade it? You enter at the opening of the next candle, placing a protective stop loss order at the top. This is what it looks like in the chart. The market's been moving down. All of a sudden, the market moves up, and you have a bearish evening star, the opposite of a morning star. This is what it looks like. How do you trade it? You enter at the opening of the next candle, and once again, you have to wait till these candlestick formations close. Once they close, you'll enter at the opening of the next candle, placing a protective stop loss order up at the top, and anticipation of the market going down. That will be all your profit, see? Risk right here versus huge reward. That is what trading is all about. And so this is what's called a dark cloud cover. Now, a dark cloud cover is the opposite of a piercing line. See that bullish piercing line? It's really the same formation, but in the opposite direction and called a different name. Instead of it saying bullish piercing line, bearish piercing line, you have a bullish piercing line and you have a bearish dark cloud cover. Now, this is where you have a bullish candle. You have the bears come in, take control. They take the candle lower than 50% of the previous candle. As a matter of fact, to have this be a valid dark cloud cover, the market needs to come more than 60% and close. This is a signal to the trader the market's getting ready to go bearish. It is a U-turn. How do you trade it? Just like you do all the other ones. You enter the market at the next candle, place your protective stop loss order above the high with anticipation of the market going south. This is what it looks like in the market. You're sitting in front of your computer. You're looking for a bearish candlestick formation. As you're sitting there, this appears. This is your dark cloud cover. Market came back more than 60%. This is what it looks like, the two candles. The dark cloud cover is not 5 candles. It has to only be 2 candles. And what do? You enter the market at the next candle, place your protective stop with anticipation of all this being your profit. This is what makes a trader very, very happy and very excited to be trading. See, this knowledge makes a huge difference in a trader's journey, because once you learn these candlestick formations, you know, it opens all kinds of doors of profitability for the trader. This, once again, is the most popular candlestick formation. This is the bearish engulfing candle. This will appear more than all of the other 4 combined. When this appears, it really is bulls were in control, followed by a bearish candle that engulfs the previous 3 candles. It can engulf the previous 1 or 2 or 3 or 4 candles for that matter. It, once again, is telling the trader, hey, look, this market is getting ready to U-turn and go back down. And so if you want to make a profit, you better get in right here and place your protective stop loss above the market, because just in case this starts to rally and we're wrong, you've got to remember the market is always right. That's why you always have a protective stop loss order, to make sure that if you are wrong, you incur a small loss in comparison to a large profit that you're going after. This is what it looks like in the market. Market was waving down, started to retrace, created a nice engulfing bearish candle. You enter the market right here. The previous 4 candles created your engulfing bearish candle, and you place your protective stop loss order above the high with anticipation of the market going down. And this is what it looks like. Market goes down in your way. As it starts to go down, it waves, because that's one thing the market does. Now, of the 5 bearish candlestick formations, once again, the tweezer top formation, which is the opposite of a tweezer bottom, appears the least, but is a very powerful candlestick formation for a trader. Even though it may be a powerful candlestick formation for a trader, you will never bet the farm on it, okay? That's not what trading is all about. But it is telling the trader, because of these decision and decision candles, these are basically somewhat of hanging men. They're called hanging men. This would be the rope. This would be the head, if you will. These are also considered bearish dragonfly dojis. These bodies of the candle could be bullish together. They could be bearish together. They could be bullish and bearish like they are. But what you need is you need 60%, at least 60% of the wick to be on the north side. And what this is communicating to the trader is that this market is really getting ready to take off in a bearish manner. It is a U-turn signal once again. How do you trade it? You enter at the opening of the next candle, placing a protective stop loss order above the high. This is what it looks like in the market. See, here we are. Look at how clear and distinct these are. These 2 tweezer tops are very different than all the other candles. And it's after a wave or a pullback. See, it's going to create a lower high, which is lower than the previous high. How do you trade this? See, this tweezer top, you trade it by entering at the opening of the next candle, placing a protective stop loss order, risk versus reward. That's what trading is all about. And then here we have the market taking off in our direction. One of the things you need to realize as a trader is there are no absolutes. You can't ever say the market always does this or the market never does this. You can't say that. What you have to say is, when these type candlestick formations appear, they land in perhaps a 70, 80 percentile of market movement or U-turn. And it is a high percentage profitable trade. That literally is a signal. See, the 5 bullish candlestick formations are bullish signals for a trader. The 5 bearish are bearish signals for the trader. And so learning spatial intelligence and understanding how these candlestick formations form really participate in helping a trader become that consistent, profitable trader, which is what they want to do in the end.